The world expected gold to surge. Instead, it did the unthinkable. At a moment when geopolitical tensions are rising, when headlines are dominated by conflict, and when uncertainty is spreading across global markets, gold, historically the ultimate safe haven asset, is not climbing. It is falling, and that contradiction is sending shockwaves through financial circles, raising a deeper and far more unsettling question. What is really happening beneath the surface of the global financials system? Because traditionally, war changes everything. Investors flee risk, capital moves out of volatile assets and into safety, and for decades across conflicts, crises, and economic shocks, gold has been that safety. From the Cold War to the 2008 financial crisis, and even during recent geopolitical escalations, gold has consistently acted as a refuge when uncertainty spikes. But this time, the pattern appears to be breaking. The immediate event triggering this confusion is the convergence of two forces that rarely collide in this way: escalating geopolitical conflict and tightening financial conditions. On one side, tensions across key regions are intensifying, creating the kind of instability that would normally drive gold prices higher. On the other, central banks, particularly in major economies, are aggressively tightening monetary policy, pushing interest rates to levels not seen in years. And this is where the contradiction begins to take shape. Because gold does not exist in isolation, it competes. When interest rates rise, the cost of holding gold increases. Because unlike bonds or savings instruments, gold does not generate yield. In a high-rate environment, investors are faced with a choice: hold a non-yielding asset during uncertainty, or move into instruments that now offer significant returns. And increasingly, many are choosing the latter. But that explanation alone does not fully account for the scale of the move. There is something deeper at play, something tied not just to monetary policy, but to liquidity, leverage, and the hidden pressures inside the global financial system. In times of stress, investors do not always behave predictably. Sometimes they sell what is safest, not because they want to, but because they have to cover losses elsewhere, to meet margin calls, to raise cash in an environment where liquidity suddenly becomes scarce. And that is where the story becomes more complex. Because a falling gold price during war may not signal strength. It may signal stress, a system under pressure where traditional relationships begin to break down, and where the usual rules no longer apply in the same way. This is not just about gold. It is about what gold is telling us, about liquidity, about confidence, about the hidden fractures forming inside a system already strained by debt, policy shifts, and geopolitical rivalry. If you want to understand why the market is behaving in ways that defy decades of precedent, and what that could mean for your financial future, subscribe now, because this is not just a price move. It may be a signal. To understand why gold is behaving so unexpectedly, it's essential to trace the forces converging on the market right now. Historically, during periods of war or geopolitical tension, investors flock to gold as a hedge against uncertainty, inflation, or currency instability. But today, that instinct is colliding with a broader financial recalibration. Central banks, particularly in the United States and Europe, have been aggressively raising interest rates to combat persistent inflation, making traditional interest-bearing assets far more attractive relative to gold's zero yield. At the same time, liquidity strains are forcing large institutional investors to sell even safe haven assets to cover margin calls or rebalance portfolios across volatile markets. Geopolitical risk, rather than automatically driving prices higher, is now interacting with these structural pressures, creating a scenario where demand for gold is muted, despite rising global uncertainty. Meanwhile, currency dynamics add another layer of complexity. As the dollar strengthens amid interest rate hikes, gold, which is priced in dollars, becomes more expensive for holders of other currencies, further suppressing demand internationally. Analysts also point to speculative trading, derivatives exposure, and the massive holdings of ETFs, which amplify market moves far beyond physical supply and demand, intensifying downward momentum. In this environment, what appears as a paradox, A crash in gold during a war is actually a reflection of deeper systemic stress, a convergence of monetary tightening, liquidity shortages, leveraged positions, and shifting investor behavior that together reveal hidden vulnerabilities in the global financial system. The lesson is stark. Gold's failure to act as a safe haven in this moment is not a quirk of the market. It is a signal that conventional assumptions about security, risk, and protection are being tested like never before. The timeline leading to this unprecedented gold behavior is rooted in a series of financial and geopolitical developments over the past decade, each compounding the other. Following the 2008 global financial crisis, central banks worldwide engaged in unprecedented monetary stimulus, pumping trillions into markets to stabilize economies, which fueled asset inflation and encouraged risk-taking across equities, real estate, and commodities. For years, gold moved steadily upward during periods of tension, reinforcing its role as a hedge. But the last few years introduced a new dynamic: rising debt levels, supply chain disruptions, and the sudden shocks of global conflict combined with aggressive monetary tightening created a pressure cooker environment. By 2020, pandemic-related stimulus further expanded balance sheets while low interest rates suppressed yields, inflating expectations for safe haven assets. When war erupted in key regions, markets initially anticipated a surge in gold, yet instead, investors faced the dual reality of geopolitical uncertainty and rising returns on other assets, leading to unexpected selling pressure. Alongside this, central bank policies began signaling that inflation would be fought decisively, even at the cost of slowing economic growth, which directly undermined gold's relative appeal. On the trading floors, leveraged positions and ETF flows magnified price swings. When some funds were forced to liquidate for margin requirements or to rebalance portfolios, it triggered cascades of selling, further depressing the market. The historical parallels suggest that, while gold has served as a barometer of global stress, the current environment is unique. War, inflation, tightening rates, and systemic liquidity strains are interacting simultaneously, producing outcomes that defy conventional expectations. The result is a timeline where each development, policy shifts, market reactions, and geopolitical shocks feeds into the next, creating a volatile feedback loop that explains why the market is behaving so counterintuitively today. To break down the gold crash in detail, it is necessary to examine how events have unfolded across multiple layers of that market and geopolitical landscape. First, the conflict zones driving uncertainty, whether in Europe, the Middle East, or Asia, have created expectations for traditional safe haven buying, but actual investor behavior has diverged. On one side, some traders anticipated a surge in position long, expecting gold prices to spike. On the other, institutional investors, facing liquidity constraints, margin calls, and exposure to other volatile assets, have been forced to sell gold to cover losses elsewhere. This divergence has intensified volatility, creating swings that are amplified by algorithmic trading and high-frequency transactions. Central banks' communications add further complexity. Signals of persistent rate hikes strengthen the dollar, which inversely pressures gold, while at the same time highlighting the tension between inflation concerns and safe haven demand. Complicating matters, gold ETFs and large derivative positions have transformed the market from one dominated by physical buying and selling to one heavily influenced by financial engineering, magnifying moves beyond what traditional supply-demand dynamics would predict. Analysts report that, in some cases, the selling is not ideological. It is mechanical, forced by systems that require capital coverage regardless of long-term outlook. Intelligence assessments suggest that this unusual behavior may also reflect deeper concerns about systemic risk. With debt levels high and geopolitical conflict escalating, investors are prioritizing liquidity and cash over traditional hedges. The evidence points to a multi-layered breakdown. Geopolitical triggers, monetary tightening, leveraged positions, and structural market mechanics all intersecting to create a scenario in which gold, paradoxically, fails to act as the safe haven it has historically represented. The strategic importance of gold in this environment extends far beyond its role as a commodity. It is deeply entwined with global economic stability and geopolitical leverage. Historically, nations have relied on gold reserves as a form of financial insurance, a way to back currency confidence and provide flexibility in times of crisis. But today, the behavior of gold markets reveals how interconnected monetary policy, currency strength, and geopolitical risk have become. When central banks tighten interest rates aggressively, the opportunity cost of holding non-yielding assets like gold rises, reducing demand even amid global conflict. At the same time, the strongest economies are leveraging gold reserves, not just as financial hedges, but as tools of diplomacy and strategic signaling, moving them in ways that can influence exchange rates and global capital flows. Critical infrastructure, including gold trading hubs, storage facilities, and clearing systems, now serve as operational points where financial and geopolitical pressures converge. Any disruption, whether from sanctions, cyber attacks, or military escalation, can ripple through markets instantly. This means that a decline in gold prices is not merely a market phenomenon. It reflects a shift in the operational and strategic calculus of states and institutions. Military conflicts, energy supply disruptions, and currency fluctuations all intersect at the level of gold, affecting how nations manage reserves, settle trade, and project financial influence abroad. Analysts warn that this structural shift reshapes risk calculations for investors and policymakers alike. Gold can no longer be assumed to function as a fail-safe hedge during crises, because its price is now influenced by layers of strategic decisions, financial engineering, and geopolitical maneuvering. In other words, the market's response is a signal of broader systemic stress, showing how intertwined war, finance, and strategic infrastructure have become in the modern global economy. According to leading financial and geopolitical analysts, the collapse in gold prices is a window into the shifting balance of power in global markets and the underlying fragility of economic systems during conflict. Intelligence assessments suggest that central banks are simultaneously managing multiple priorities: controlling inflation, defending currency strength, and maintaining sufficient liquidity to navigate escalating geopolitical tensions. Think tanks point out that in such environments, traditional safe havens like gold may be sold, not out of fear, but out of necessity. Funds must be mobilized to cover exposures elsewhere, especially when war and conflict create unpredictable demands on capital. Military analysts further emphasize that wartime pressures extend beyond the battlefield. Defense spending, supply chain disruptions, and strategic resource allocations can all force governments and large institutions to liquidate holdings, including gold, to maintain operational readiness. Policy experts highlight another critical factor: the rise of alternative financial networks, digital currencies, and commodity-backed trade agreements reduces the reliance on gold as a stabilizing instrument, meaning that even traditional hedges are now vulnerable to policy shifts and international maneuvering. Academics studying historical crises note that these patterns, forced asset sales during periods of combined war and financial stress, have repeatedly preceded significant market corrections, sometimes triggering broader shifts in wealth distribution. Taken together, these expert perspectives reinforce the idea that the gold crash is not an anomaly, but a symptom of deeper systemic forces, converging economic, geopolitical, and operational pressures that are redefining how traditional safe havens behave in real time. But the other side presents a contrasting interpretation. Some analysts argue that the current decline in gold does not signal systemic collapse or strategic failure, but rather reflects a temporary rebalancing in response to extraordinary circumstances. From this perspective, central bank rate hikes and rising dollar strength are creating conditions where holding gold is comparatively less attractive, but this is a predictable market response rather than evidence of long-term instability. Diplomatic observers point out that war, while intensifying uncertainty, has not disrupted the underlying financial infrastructure. Gold trading, clearing mechanisms, and reserves continue to function, allowing for eventual market correction. Furthermore, some investors see the sell-off as an opportunity. Historically, periods of gold weakness during crises have preceded significant rebounds once liquidity pressures ease and markets recalibrate. This alternative view emphasizes adaptability and risk management, suggesting that what looks like a crash may, in fact, be a phase in a broader cycle of realignment. Analysts also note that speculative positioning, ETF rebalancing, and derivative exposure often magnify short-term moves, exaggerating declines that might otherwise appear moderate. In other words, the falling price of gold could be a reflection of temporary technical pressures, not a permanent breakdown in its safe haven role. While caution remains warranted, proponents of this perspective argue that understanding these dynamics allows investors and policymakers to navigate the current volatility without overreacting. Recognizing that gold's fundamental value and strategic importance have not disappeared, they are simply being tested under unprecedented conditions. The global consequences of a gold crash during wartime ripple far beyond the markets themselves, touching energy prices, currency stability, and broader economic confidence. As gold falters, investors and institutions reassess risk across portfolios, often reallocating capital into bonds, equities, or cash, which can amplify volatility in other markets. Rising interest rates compound the effect as borrowing costs increase. Businesses and governments face higher debt service obligations, slowing investment and potentially reducing economic growth. On a geopolitical level, nations reliant on gold reserves for currency backing or as leverage in trade negotiations may find their strategic position weakened, influencing negotiations over energy, commodities, and supply chains. For consumers, these dynamics are tangible. Energy and food prices may spike, inflationary pressures persist, and access to capital can tighten, affecting everything from mortgages to business loans. Military spending also interacts with these financial shifts. Nations under pressure may divert resources to defense, creating fiscal strain elsewhere. Furthermore, as alternative financial mechanisms, digital currencies, bilateral trade settlements, and commodity-backed agreements gain traction, traditional indicators of economic stability, like gold, may become less predictive, challenging both policymakers and investors. The cascading effect of these interconnected forces illustrates how a single market signal, the fall of gold during conflict, can resonate across multiple layers of the global system, underscoring that financial, geopolitical, and operational risks are now deeply intertwined, and that the decisions made in response today will shape both the strategic landscape and the daily realities of economies worldwide.